The combination of the food crisis, the fuel crisis, and I guess soon the climate crisis as well, is having a tremendous effect on poor clients, as well as the microfinance institutions that serve them. The World Bank is estimating that between GDP shrinking and investment going down and all the other impacts of the economic crisis, that the economic crisis will kick another 50 to 90 million people into poverty that weren't going to be poor otherwise. And this is on top of the 150 million that they're estimating were pushed into poverty from the food crisis. 150 million people, that's the population of Mexico or Russia. It's huge. We're seeing the incomes of poor families going down almost regardless of their business unless they're doing farming. And we're seeing their expenses going up, both food and energy. On the remittance side, we're seeing some unexpected effects. Remittances are clearly going down in a lot of countries, particularly those that are contiguous with big markets like the U.S. But there's some markets where, oddly, we're seeing remittances going up. It's unclear why that is. In some cases, it may be a flight to quality where people working abroad are sending more money home because they think they may lose their job and have to go there themselves. And in some cases, it's because the dollar is so strong that the local currency equivalent of a fixed amount of remittances that was sent every month is now higher in terms of its local currency value. So we're seeing different things on the remittance side. But overall, in Africa, in Asia, and Latin America, and particularly the Middle East, remittances are down. So families are basically seeing their purchasing power really deeply undermined. And there's all kinds of coping mechanisms for this. We're seeing people certainly cutting back their business, working longer hours, taking children out of school, going hungry in some cases, but certainly spending less on food. That's been clear from the surveys we've done. And many of them are taking their savings out. They're spending down their savings because they can't make ends meet otherwise. And a lot of these coping mechanisms, like taking girls out of school, will have really lasting negative effects on women and in children in particular. So we're really kind of worried about what's going to happen next, because clearly the final step of the economic crisis has not quite yet reached the shores of many poor countries, and it'll be big when it hits, very big. So that's a concern. Now, obviously, the sort of closed circuit ecosystems, subsistence-based microeconomies are going to be less affected, but they too will be affected, and they have less cushion than the others. So clearly, as these crises, food, fuel, economic crises, affect poor customers, so will they affect the institutions that serve them. We're seeing the main impact on microfinance institutions being on the credit side. A couple of months ago, microfinance institutions were anecdotally telling us that arrears were going up. Par 30 was going up, but Par 60 and Par 90 wasn't. So people were paying late, but they were paying pretty well. In the last couple of months, we've seen that no longer being the case. We just completed a survey of 400 microfinance institutions in which over 60% said that they have definitely seen portfolio risk going up and repayments going down. So credit risk is the biggest thing that's happening at the microfinance institutions side. In addition to portfolios at risk going up, we're seeing loan size shrinking, we're seeing portfolio shrinking, and we're seeing liquidity being an issue as well. So how have the microfinance institutions been responding to this credit deterioration? Well, frankly, some of the responses are healthy ones in the best of times. They've been slowing down their growth. They've been more rigorous about credit procedures. They've been not making new loans and not making bigger loans. And they've been just working and finding ways to cut costs. Interestingly, the margins in microfinance are healthy, so they can take some hits there. But so far, we haven't heard much about interest rates at the client level being raised. Taking prudent measures, whether that's from pressure or from prudence, it's not clear. And these are all welcome things because, frankly, I think microfinance have been growing in some regions at rates that were unsustainable. And in some cases, rates that were masking deficiencies in internal systems and in portfolio qualities. Now, there's been much concern about liquidity risk, particularly for those microfinance institutions that have become heavily reliant on cross-border funds, something we've been talking about for many years. And of course, the microfinance institutions that have become reliant on hard currency cross-border funds are finding themselves very exposed as those funds pull out. And indeed, we've seen commercial banks and other international investors pulling back quite significantly or threatening to. Now, most of these loans are going to come due over the course of 2009, so it's not super clear what's going to happen, but we certainly have a strong indication that the international banks are wanting to either withdraw lines, not renew lines, certainly jack up the rates, roughly on average of, say, 200 to 400 basis points is how much we're seeing the rates go up by. But interestingly, while the international commercial financial institution players have pulled out, at this very same time, and totally appropriately, the socially responsible investors have stayed the course in a remarkable and an admirable way, as they should. The DFIs, like the IFC and KfW and now the IDB, have kicked in with really well-coordinated emergency liquidity facilities for the top-tier institutions, which is fantastic, as long as it's priced as a genuine emergency liquidity facility and not in a way that crowds out local markets. The microfinance investment vehicles, the other sort of part of socially responsible investment in microfinance, have also stayed the course. There have been very little redemptions, and in fact, last year, when you look at the markets as a whole, emerging markets funds saw a sell-off of around 10% of the total assets, net asset value, whereas at the same time, the microfinance investment vehicle in 2008, same period, grew by about 30%. And they're not seeing significant declines. They're seeing slower growth, but no significant decline. So, in fact, all the talk about microfinance going to the mainstream capital markets, which we've never felt was the appropriate place for double bottom line investing yet, well, someday hopefully it will be, but not yet, has resulted in a shift of recognition that for the time being, when you have to look at cross-border funds, it's better to go to socially responsible investors and not the mainstream. That leads me directly to the critical importance of savings and local funding for microfinance institutions. Clearly, the end game for all of us is to build domestic financial markets that have intermediaries that are effectively intermediating between the demand for a safe place to save money and the demand for credit. And the whole notion that the money needs to be moved from the north to the south needs to be supplanted by the notion of intermediating funds domestically. So to the extent that microfinance institutions had, savings as a key funding source, they were more resilient than those that didn't. And we hope this provides an added boost to the whole mission to increase microfinance institutions' integration into their local capital markets domestically, particularly when it comes to deposit mobilization.